Hello, everyone, and welcome to the Value-Driven Ownership Program. Today, we will be taking a deeper dive into something called EBITDA, a profitability and value factor, part 2 of a 4-part series examining the key assessment factors involved in doing a valid feasibility analysis. Big picture, EBITDA is important because it allows you to measure performance across numerous companies and your industry without considering specific decisions made related to funding needs, capital investment methodologies, tax environments, and more. Bottom line, EBITDA makes competitive analysis possible by normalizing business operating activities. I'm Debbie, a certified SBDC advisor at the Colorado Small Business Development Center under the SBA. I am also a former business owner myself, a former CFO for multiple startups in the Silicon Valley, and a CPA with a master's in finance. And I'm here today to help you understand EBITDA, how it can help you, 1, benchmark profitability using an EBITDA margin, and 2, be used to calculate a value for your business using an EBITDA multiple. So, let's get started, folks. Let's take a look at what this thing called EBITDA actually is. EBITDA, the technical definition, is earnings before interest, tax, depreciation, and amortization. And what does earnings mean? Earnings means net income. But then we have to adjust this thing called EBITDA to eliminate non-operating and extraordinary items, activities outside of normal operations. Let's look at a calculation so we can see how the numbers work. We start with net income for Robust Coffee, 2 years after launch of $100,000. Then we add interest expense of $3,000, tax expense of $1,000, depreciation of $2,000, and amortization of $1,500. This results in an EBITDA number of $107,500. But then we have to adjust this number for one-time and/or extraordinary items, such as a product line shutdown for $2,000, a lawsuit settlement of $1,500, and all of the other net non-operating activities, which might include interest income and gain or loss on asset sales. In this case, a total of $500. This gets us to an adjusted EBITDA number of $108,500. Now, this number is often close to the net operating income on your income statement. Why is this profitability metric so important? What's wrong with the income statement? You can think of EBITDA as an equalizer of sorts for profitability and value computations. What we are trying to do is compare profitability and value across companies and the industry overall. By eliminating non-conforming items or specific items unique to a company, such as capital expenditures, infrastructure items, debt service, capital structure items, and items related to tax environments. It also eliminates non-operating business activities. This is important because net income includes both operating and non-operating business activities, while EBITDA includes only operating activities. So, think of EBITDA as a measure of profitability related to core business operations, fundamental, essential operating activities required to deliver products and services to customers. It's the reason that the company exists. Let's take a closer look. I want you to understand what profitability really means and not get lost in your income statement. Business activities for profit-related performance appear on the income statement in two categories. 1, operating activities, and 2, non-operating activities. Operating activities are the core activities of any business. They can be direct, such as income and costs related to producing and delivering core products and services, or they can be indirect, generally the ongoing costs of running a business. Direct operating activities are included in gross profit. As a reminder, gross profit is net revenue minus cost of goods sold. Indirect operating activities include operating expenses, fixed and variable costs such as rent, utilities, and marketing that generally increase or decrease with the overall growth or decline of the business. Gross profit minus these operating expenses equals net operating income. Now, let's talk about non-operating activities, what I call the incidental activities of a business. They are all indirect activities that don't relate to the core business at all. That's why we use the word other when we talk about them. These activities include other income and other expense. Other income minus other expense equals net non-operating income. Net operating income plus net non-operating income equals net income. Now, the number you should care about in all of this is net operating income, the profitability measurement for core activities that often get adjusted to get to EBITDA and calculate an EBITDA margin. Okay, let's see where the EBITDA margin is in IBISWorld and do some benchmarking. Industry data for EBITDA can be found on the Contents page. Select Key Statistics. Then, go to the Industry Financial Statement on page 37 and look for operating ratios. As you can see, the calculation for this ratio is EBITDA divided by revenue. The 3-year EBITDA operating ratio is 19.2%. And now, Let's do some benchmarking using the EBITDA margin or operating ratio. Benchmarking profitability for robust coffee using the EBITDA operating ratio works like this. First, let's look at the industry data in IBISWorld. The 3-year average was 19.2%. The 5-year number was 15.6, and the 10-year number was 12.1. The average of these three ratios is 15.6%. Now, let's look at individual competitors, publicly traded companies, using data from 2022. The Starbucks margin was 19.06%. The McDonald's margin was 48.5%. The average of these two competitors was 33.8%. Since the range between the industry and the individual competitors was so large, we will look at the median of 24.7%, basically a number right in the middle. The robust margin was 29.8%, higher than the industry average by 15.6% and lower than the competitor average by 33.8%. Robust was somewhere in between the industry and competitors, amazingly close to the median. Bottom line, robust efficiency is good, much better than the industry and close to the competitor median. Costs are under control and cash is available to fund financing and investing activities, loans, capital expenditures, etc., or to ramp up growth, the company's operating activities. And that's what a good EBITDA margin is all about. Okay, it's time for a deeper dive now into the value of your business. How much is it worth? We will look at two of the common ways these calculations are done, based upon either 1, the net assets reported on your balance sheet with various market adjustments, or 2, an adjusted EBITDA number derived from your income statement and multiplied by a benchmark. The EBITDA multiple. Importantly, both of these methods rely upon a clean set of books maintained using generally accepted accounting principles, referred to as GAAP, rather than tax regulations. Even if you don't understand GAAP right now, know this: neither of these valuation methods work without a clean set of books. And if you focus on tax regulations to minimize tax payments, value will be reduced because tax deductions reduce net operating income and therefore EBITDA. Let's look first at where net asset value comes from. Unravel the balance sheet mystery. I want to start here because that's where valuation begins, on an often misunderstood and abused basic financial report. And yet, it's the foundation of value. I like to call it a net worth statement, another term often used by experts in the financial world. In both cases, some simple math needs to be done. You add what you own, assets, and subtract what you owe, liabilities, to get a preliminary valuation, or an equity number. The equity number is also called net assets, which is equal to net worth. In this case, $75,488. Some businesses sell based on net asset value, also called net worth. Now, let's do this math using an actual balance sheet. Let's look at something called equity ownership. Let's do this math using a balance sheet for Robust Coffee, a simple one. And let's look at something called equity so you understand ownership rights and how they may play into the purchase or sale of your business. First, let's do that basic balance sheet math. Assets minus liabilities equals equity. What you own, assets minus what you owe, liabilities, equals net worth, or equity. And net worth consists of common stock, owners with basic ownership rights, preferred stock, owners with preferential ownership rights. These owners usually have majority voting rights. They get paid first when there's money, they make the most money, and they take the most risk. Sometimes an owner has to raise money to make money, bring in outside investors to help grow the business. Angel investors, high net worth individuals, a venture capital firm, a private equity firm, and of course, family and friends. There is also something called a convertible bond, a bond that converts to common stock if the business is sold or goes public. Usually, there are some preferential rights here related to interest payments and voting. And guess what? Now, you are sharing the net worth you own. And in an LLC, there are often classes of membership units, so even rights among preferential owners can vary. At the moment, the value of this company on a net asset basis is $370,000. $380 minus the cash of $10,000. This represents a return of capital shortfall of $85,000 or 18.7%. That's a lot. How did I figure this out? Well, I looked at the capital structure for Robust Coffee, the ownership sharing, which consists of equity investments and financing. Yes, lenders are effectively owners. Most of them stand first in line when it comes to liquidating or distributing assets, a sale, via a merger, or maybe even a bankruptcy. In this case, there is a bank line of credit for $25,000 and equipment loans for $50,000, for a total of $75,000 from financing. Equity investments consist of owner contributions equal to $30,000, contributions from family members of $50,000, friends of $52,000, and angel investors of $275,000, for a total of $380,000. This results in total capital or funding sources of $455,000. 83.5% comes from equity investments and 16.5% from financing sources. Note that only 6.6% of total capital came from the owner. And now we're ready to talk about that return of capital shortfall. Value is estimated to be $370,000 minus the total capital of $455,000. That equals a shortfall of $85,000 or 18.7%. If there was a sale today, guess what? The owner would get nothing. Okay, maybe it's worth a little bit more or less than $370,000, depending upon the market value of the inventory, the furniture, and the equipment. There may also be adjustments related to debt and receivables that might be off the books, and contingent liabilities related to contracts. Sometimes an adjustment for an escrow deposit is required. Bottom line, for the most part, the net asset value method is not a great way to value your business. When is it used? The net asset value method is generally used when earnings and cash flow history are problematic. That means there is not an established earnings and cash flow history. Earnings are volatile, or earnings do not exist because the company is in the startup mode. It is also used when tangible assets are significant. There are mostly liquid assets, securities, real estate, mineral rights. Tangible assets, things you can touch, like property and equipment, continue to benefit the company. They are not fully depreciated. And intangible assets are minor, things you cannot touch, like patents, copyrights, branding, and customer loyalty. Other criteria considered when using this method include the business is a going concern. That means it has longevity. The business relies heavily upon contracts. It's easy to enter the industry. And there is no consistent, predictable customer base, or the financial records are a mess. I can't say this enough. You will hear me say it a lot. You need a clean set of books. Let's move on now to the more widely used valuation method, the EBITDA multiple, a financial ratio that compares enterprise value to annual EBITDA used to determine value and make comparisons. It is equal to enterprise value, the entire market value of the firm, all ownership interest and asset claims included, divided by annual EBITDA, a historical number or forecast estimate derived from the company's income statement. The enterprise value for a public company is based on the price of the shares in the public market. Using EBITDA in the calculation helps normalize the valuation process. These multiples are then used by private companies to benchmark value. Sometimes as many as 8 to 10 Multiples are used in a benchmarking exercise to hone in on a more accurate value estimate. As you will see, in our simple example for robust coffee, multiples can vary among companies for many reasons. Product and service lines, size, locations, management approach, and expertise. There are lots of reasons, and that's why you may need more data points to do a proper analysis. IBISWorld can help you identify some of these competitors. Check out the page called About the Industry. Financial analysts are another good source of information. I discovered McDonald's this way. Let's take a look at an EBITDA value calculation for robust coffee now. Let's use the EBITDA multiple derived from the income statement to calculate value for robust coffee. We start by selecting a reasonable multiple based upon industry data from various sources and actual multiples reported by individual competitors, publicly traded companies. Raincatcher, a valuation expert, reported a 4.0 multiple for the consumer goods and services industry. Peak Business Valuations, another expert, reported a range of 3.0 to 5.0 for small business in general. And Equidom, another expert, reported 7.35 for the food, retail, and distribution industry. Collectively, these sources result in a 5.1 average multiple. The Starbucks multiple was 18.5 and McDonald's was 19.7. Together, they result in an average of 19.1, much higher than the industry average, which makes some sense, right? These are large, successful companies with a market cap greater than $100 billion at the time of this recording. They've been around for 50 years, and as a result, I will use them as a frame of reference, but exclude them from the robust valuation. Robust is only roughly a $500,000 company and less than 3 years old, so it's not really comparative to these larger companies. So let's do an EBITDA multiple value computation using an EBITDA multiple of 5.0. Multiply that by an adjusted EBITDA amount of $108,500 to get an EBITDA value of $542,500. If you can compare that to the net asset value of $370,000, you get a value difference of $172,500 or 46.6%. The EBITDA value results in 100% return of capital plus 46.6%. And now, let's talk about your homework assignment. Your homework assignment is focused on collecting data to measure profitability and calculate an estimated value for your business. It has 2 parts. 1 relates to operating expenses. You do this on the operating tab in the feasibility model for both indirect costs and indirect labor. And 2 relates to EBITDA margin and multiples. You do this on the industry tab in the feasibility model for both the industry and individual competitors. I need to figure this out, you should say to yourself, if my business is going to be profitable relative to the industry and to my competitors. And that's it, everyone. The end of our deeper dive into EBITDA. But before you go, I want to highlight some of the most important things we learned today. 1. Adjusted EBITDA is a normalized profitability metric that allows you to compare operational earnings against companies large and small and the industry overall. Benchmark your company's financial health. It also allows you to calculate a value estimate for your company. 2. The net asset valuation method is another way to calculate a value estimate. However, it is generally only used under specific circumstances. Most business owners and financial experts prefer the EBITDA multiple method, as it usually results in a higher value. And 3, most importantly, maximizing the value of your business is highly dependent upon keeping a good set of books using management reporting principles, GAAP, rather than tax regulations. Net asset value is derived from your balance sheet, and EBITDA is derived from your income statement. So, don't be lazy. Keep a good set of books. And don't be cheap. Be willing to pay for professional help if you don't have the time or willingness to do this work yourself. Next workshop, we will talk about free cash flow, a sustainability factor that considers infrastructure requirements and your financing needs. So, stay tuned, and I'll see you all soon.